Hello and welcome to LBMA webinars. Today is the second part of our Digital Gold series. Our host is our very own Sakhila Mirza. She'll be joined by Charles Cascarilla, CEO and founder of Paxos, and Raghav Chawla, Director of Project Management for Fidelity. If you do have any questions today, please submit them using the Q&A function, and we'll be able to get those questions to the panel who'll be able to answer them. But for now, I'll hand over to Sakhila.
The audience would love to hear more about what's going on in the US and perhaps listen to me speak, but we're going to save that conversation for next week. So do join the webinar next week, but I do want to divert our attention to perhaps one of the most important ongoing developments that we are facing. The world is turning digital. And it has been for several years now, but I'm focusing on a very specific area. Obviously, it's financial services, but within that, digital gold or digital assets. We had our first of the series where I was joined by Danny Masters of CoinShares, a large digital asset exchange, and also Peter Groskopf, the CEO at Sprott, which is a global investment manager. And they both, at the first series, discussed their views on the benefits of digital gold and the challenges that exist. I mean, Danny went on to say that, increasingly we want more scrutiny, we want more control, we want to lower those costs, and actually digitization helps to address those considerations. Peter mentioned regulation, the need for credible exchanges to embrace this digitalization assets. Is absolutely essential for the future of these markets. So both very supportive of digital assets. So with that, I'm going to turn to Chad first. I know Paxos has a digital gold token. So first, I'd like to get your sort of perspective, Chad, as to why did you launch a digital gold token? What do you think are the benefits from your perspective? And what are the challenges? So over to you, Chad.
Thanks for having me, Sakhila. It's great to be here. Good morning. So I think it was really a very logical thing for us to launch a gold token, given what we're trying to do at Paxos, which is to be infrastructure for the blockchain-based financial system, the more open financial system that we think is going to evolve from the one that we're in now. And that doesn't mean that you don't need regulated institutions and you don't need infrastructure. We think you need both. And that's what the mission of Paxos is. And so within that mission, we oftentimes think about how are the $600 trillion of assets that exist in the world going to eventually move onto a blockchain? Because I think that will very likely happen. And that will probably take some time, 10 or 20 years journey for all of them to migrate. And so you think then, what is the most logical assets to begin that journey first? And I think what we've seen is the first asset to move has been cash. And that's because in order for you to be able to move assets around, you need to be able to have cash move around just as quickly. And so cash has been pulled into the blockchain world because of how much innovation and excitement has happened in the crypto space. And I think the next most likely asset to move over is actually gold. And the reason is, I think, two or threefold. The first is gold and commodities have a bit of a problem, which is that you either have a lot of liquidity, but you don't own the underlying, or you own the underlying and you don't have liquidity. And so you could go trade the ETF or you can go trade futures, but you're limited to the hours that those institutions are open, meaning CME futures or the US stock markets or whatever it might be. So you're really trading, for 8 hours a day, less than 5 days a week. And then on the other hand, if you want to have the security of physical gold, you buy the physical gold, you hold it somewhere, maybe a safety deposit box or your backyard, but then you have to go back and sell it. There's very high frictional costs and it's not practically usable then. It's very safe, but it's not usable. But if you digitize gold, it actually gives you the best of both worlds. And the way we've digitized gold is very novel. The first thing is it's based on LBMA gold. It's held in the London vault. So I think that's unique. Others haven't done this. Secondly, it's a regulated gold token. So our regulator, the New York Department of Financial Services, oversees our gold token. So we have a primary regulator of the actual token itself. And that's how you know that if you send us dollars or whatever currency it might be, and we send you a gold token, it is fully backed by gold sitting in a Brinks vault in London. And we're adding other vaults as well. And you can actually see the serial number of the gold that you own in that vault. And now you can withdraw that gold token and you can send it anywhere. And you don't need an intermediary in between. That's a really big difference between how gold exists today, where it's either there's no intermediary and no one is really sure if they can trust it, or there's a huge chain of intermediaries and there's very limited utility. You actually own what I would call synthetic gold. And that's not necessarily bad, but I think tokenized gold gives you the best of both worlds, which is a bearer asset that you can move as you would like, but it has the speed of the internet behind it. And it has the regulation to know that those assets are there. Fully bankruptcy remote, fully segregated, backing each one of our tokens. We have it audited every month. We have a significant amount of oversight. We have an independent board of directors. We have Deloitte & Touche is our auditing. Grant Thornton does our external auditing. We have 6 weeks of exams from the New York Department of Financial Services every year. This is just a different level of oversight from anything that exists in the industry today.
Thank you. So would you say then, given, I mean, it sounds like there's a lot of regulatory, like you just said, oversight, and there seems to be compelling reasons, as you've just highlighted, for digital gold. Where would you say, given this is a multi-trillion-dollar market, I mean, when I say this market, the gold market, and, you know, there has been some discussion about, well, gold tokenization is still very, very small. Why do you think it's not as big? I mean, is it just the beginning? What needs to happen to really penetrate the market, the multi-trillion-dollar market, given the size of the ETFs, for example? What would be your sort of views on that?
I think there's a couple of reasons. The first is there's a change of behavior here. You have two things that are going on. One is you have to adopt blockchain, and then within blockchain, you have to then decide I'm going to use gold as an asset on the blockchain. And so there's a bit of an adoption curve that needs to happen, and that hasn't been made quite simple enough yet. But then secondly, I think it's just because we're early. And the reality is, I think this trend is really an inevitable trend about where assets are going to sit. And right now, for instance, our Pax gold token has about almost $75 million of gold backing it, something almost like 37,000 ounces. So this is really the largest gold token, and it's a regulated gold token. And what's important here is the rate at which it's changed. So since the beginning of the year, we were at maybe $15 million of gold, and now we're at 75 million, and it's growing a lot. It's growing millions and millions of dollars a week. And I think, you know, anytime you start something, it always starts small, and then it begins to compound. And the compounding is actually very large in percentage terms. It's just still small in dollar terms. But if you look at the ETFs, it took quite some time for the gold ETF to scale to the size it is now. New innovations always start small because it's new, and there's an adoption curve that happens. You would never think that you're going to start something new and suddenly the whole world will be on it. The whole point is that you're constantly iterating, learning what customers want, and responding to that and growing it. And I think that's what we're seeing now. And I can tell you some of the partnerships that we have in the pipeline will be able to bring digital gold to hundreds of millions, if not billions of people within the next 18 months. So I think that the adoption curve here for both blockchain-based assets and specifically gold are very, very bright. And that is, I think, really where the future is going to be.
So just sort of quickly on the point about it's going to be more accessible by several billion people. At the moment, who's actually buying? Who's your customer at the moment?
Yeah, well, it's actually a range of different types of institutions and to some extent retail. So Paxos itself has infrastructure. Generally, our customers are either very sophisticated individuals, but generally businesses, B2B businesses or B2B2C businesses. And so we have numbers of different types of partnerships, including many firms that are very active in the gold market today. And we think that on the one hand, Pax Gold might be more of a retail product today because that tends to be who are the early adopters. Institutions tend to move more slowly. They're more conservative for obvious reasons. They have larger dollar amounts. But on the other hand, I can tell you we're spending a lot of time with large institutional players in the gold market where having tokenized gold isn't just something that's great. You have a bearer asset as a retail investor. but large players in the gold market can now use it to be able to mitigate their own risks. So, you have a capacity now to be able to move digitized dollars and digitized gold to settle very large trades and reduce counterparty risk and create a different mechanism for being able to solve some of the problems that exist in general in financial services around large institutions settling with each other, but also specifically in the gold market. And so I think we're seeing it across the board. We have institutions that are market making firms, public companies that are using our products, that are settling using gold and our dollars today, as well as high net worth and retail. So it's the gamut, because financial services is a gamut of people.
Great, thank you. So I'm just going to pause there and turn to Raghav then. We've heard lots of, like I said, compelling reasons from Chad in terms of case for digital gold. There's definitely potential for growth there. I want to sort of get your views on some of the points that have already been made. What do you think? Because I know when we were speaking earlier on, you used the term that Bitcoin is king. And sometimes what you find with tokenization, it gets compared to some of the existing cryptocurrencies. Just want to get your sort of view as to where you think we're going with tokenization, digital assets, and to the extent that you can comment on some of the benefits that Chad has highlighted would be great.
Sure, yeah. So, I mean, I do agree with a lot of benefits that Chad just outlined. And the way I see this whole space, if you kind of just pull back for a minute and just think about, what do blockchains really give you? There's one side of it, which is the private permission blockchain space, which is not really relevant to probably anybody listening on this call unless you run some sort of back office company to run the financial infrastructure, because that's like company to company. They can run private blockchains amongst themselves to make their processing easier, but the end user retail customer doesn't see any of that. It's just like an upgrade from Oracle 11 to Oracle 12, like they don't really care. So there's that. Then when you look at the public blockchains, which I call the real blockchains, you're essentially getting two new things there, right? One is the transactional side of things, where you have peer-to-peer transfer without any intermediaries, and within minutes, and then you have peer-to-peer exchanges as well. These decentralized exchanges where you can exchange from one token into another token. You can custody yourself, so you don't need to rely on a third-party custodian to hold your assets for you. So you can get that surety that there's no counterparty risk there of somebody else being insolvent. So you get a lot of these sort of transactional benefits of using that means of trading and holding the assets. And then there's the monetary aspects of some of these coins. You mentioned Bitcoin. Like to me, when we first talked about this webinar, you mentioned digital gold. I was like, oh, digital gold is Bitcoin. And the reason I said that is, you have all these new tokens coming out, and with these new blockchain-based tokens that are digitally native, they're not a real-world asset that was tokenized onto the blockchain. These assets were born on the blockchain. They're digitally native, and their monetary properties are hard-coded in. They're baked in. And Bitcoin was, in fact, originally, its monetary properties are modeled after gold, like the mining schedule. That's why we even call it Bitcoin mining, because the rate of generation of new Bitcoin was actually modeled after the way gold is dug out of the ground. And so from a pure monetary property standpoint, you have Bitcoin and gold. One is physical and one is digital. And particularly in this sort of environment where lots of central banks are printing all this money and there's risks for inflation in the future, I think it's gold and Bitcoin are your two sort of fallback hedges against macro hedges against the global system collapse. And so that's why I think Bitcoin is still relevant. So I guess for somebody wanting to invest in, say, a tokenized gold or Bitcoin, the question you ask yourself is like, why do I want to buy this, right? Is it purely from a transactional standpoint? Then you see, both options are in play, because on the one hand, you have something that's physical, that's tokenized, but somebody else is holding the actual asset for you. So you still have that sort of distance between the real asset. You can, it's almost like, going back to the gold standard back in the day when central banks would hold golds in vaults and issue paper IOUs really that you pass around to do the transaction. That's basically what tokenized gold is. Except instead of a piece of paper that says that this piece of paper is worth this much gold in this vault, it's this blockchain token. And so you can get, so if you're not super, just really motivated to just own gold, and you kind of just want something that's like gold that you can hold yourself, and you're not subject to all these other risks that come with something that a third party is tokenized for you, then I think Bitcoin is a viable option for you as well.
Very well, thank you. Very interesting there, Raghav. So you work for Fidelity, and they are a custodian of digital assets. Where do you see digital gold in your sort of portfolio, or in that portfolio? Is that something that Fidelity is looking at? Why have they? And first, I mean, the first question should be, why has Fidelity stepped into this space? What's been the motivation?
Sure. So I mean, the motivation is that we see digital assets as the future of finance. So again, like all these transactional capabilities that I was talking about, at the end of the day, pretty much any asset on the planet can be tokenized and put onto a blockchain and traded in that way. And so what we wanted to do, and right now we offer institutional custody for Bitcoin, but the plumbing that we've built in order to offer that service to our institutional clients, where we can, they can buy Bitcoin from us and they can hold Bitcoin with us, and we have trade execution platform as well. So the reason we built that is because, again, we think that digital assets is the future of finance, and now that we've built the plumbing for Bitcoin, it's very easy for us to add any other digital asset in the future that we would want to service. Of course, we don't want to be too sort of cavalier with the assets that we offer our customers. So Bitcoin is super established. It's the king of the castle when it comes to digital assets, and that's why we started with Bitcoin. And in the future, we may add other assets as well as they become more prominent and our customers demand them.
Okay, so then we've spent quite a bit of time in terms of the strengths and the benefits. What's been the biggest challenge that you faced, Chad, with, I guess, Pax Gold, or just generally in this marketplace? What's been your biggest challenge, and how can we possibly address that challenge?
Yeah, I think the biggest challenge is always, when you do something new, inertia. There's a way that people are doing it today, and obviously that works to some extent. And so there's switching costs to do something new. And switching to doing something new means you have to make sure that there's enough benefits and there's time. And so I think that that's the biggest issue for me, is just that there's time and there's inertia. And so how do you, and probably the last thing I would add is ultimately markets are networks. And whether they're working on private networks or public networks, they're still networks. And so that makes the switching costs more expensive potentially than something where everything is just done between one other person. And that's also why there is such huge benefits to when you hit a tipping point, because networks work against you when you're trying to move them, but they're working for you when they start to work in your direction. And I think that's what really needs to happen, is you get to a critical mass of users. And I think, we're still not there yet. Clearly $75 million of tokenized gold, as you pointed out, is still a small number in the scope of the size of the gold market. But on the other hand, if you have another 5 to 10x growth in that, which I think is very, very reasonable next year, you could be at potentially as much as $1 billion of tokenized gold. And I think, you're really starting to cook with fire when you get to that point. And I think the year after that could be another 10x. And now you're really getting to really more wide adoption. And that's ultimately what needs to happen. And by the way, that's not just true for digitized gold, that's true for blockchain technology. And so it's always hard to pull the two apart, because effectively, when you're rewiring the financial system, just like the gold market is a private network, the financial system itself is a private network more broadly. And creating the infrastructure that allows the financial system to migrate is what's also going to allow the gold markets to migrate. And I think, in fact, that's very positive for the gold market, because in some ways gold, even though it's a huge asset class, is somewhat anachronistic. It's a physical asset. It's a physical bearer asset. And you've done all these workarounds to try and fix the problem that it's a physical bearer asset, but it usually inevitably introduces counterparty risk in some significant way. And if you can instead keep the physical bearer asset nature of gold, I think there's a really bright future for it to be used. On the other hand, it could be that other digital bearer assets like Bitcoin become widely used because they're natively digital. And so I think that there will be some existential issues for the gold market to adopt this methodology of how things move over time, because having a physical bearer asset, physical token, it only has so much utility in today's world. Everything is going digital, everything is going online, everything is going electronic. You want to be able to use it. And so large swaths of the world, that's not relevant. But it will be in 5 years. The trend isn't changing. Everyone has smartphones. More people have smartphones than bank accounts, as crazy as that sounds. So, what is the world going to look like in 5 years? I mean, we know which direction it's going. How do you adapt to it so that, we're not all in the gold market kind of holding on to past glories and the historical way of doing things, but the world is passing us by. And I think this is the opportunity.
Great, thank you. I mean, I'm seeing a lot of questions coming through. I'm still going to just pause on the questions. So, I mean, in fact, Chad, you made the point about it's not just tokenization, it's about, rewiring the financial system. So with that, I'm going to move to Raghav. So tokenization is not the be all and end all, clearly. What else do you think, where else, or what can be a bigger benefit to the extent that you think this technology can help the financial markets and more specifically the gold market? What are the other use cases?
So I think, again, we talked about Bitcoin earlier. I think, the primary use cases that I'm most excited about in this whole blockchain world is the digitally native assets. Because with the digitally native assets, that's where you get a pure bearer asset. You get all these properties of, there's no risk from any other party. You're kind of not dependent on government monetary policy in any way. It's literally the freest market that's ever existed before. And the most self-sovereign market that's ever existed before, where people can participate however they want. And I mean, if you want to use a third-party custodian, they exist. If you want to hold a token yourself, you can do that. If you want to save on fees and use a third party that pays fees for you to do the transaction and makes it easier for you, you can. If you want to, do your transactions on your own directly on the blockchain, the only thing you're trusting is the blockchain. And the blockchain is basically software that's implementing math. So as long as you believe in mathematics, you can trust in these digital assets that they're going to work exactly the way you expect them to. Versus when you have a third-party institution and when you have other like physical stuff, then you're dependent on humans, and humans are fallible in many ways. And so you kind of have that additional thing that you have to trust on top of just pure mathematics. And and because this is just code with digital assets, they're just software. There's no there's something backing here and there's something backing there and there's something in a vault. It's 100% programmable. So you can do all sorts of new financial products that could never have existed before in the traditional world, where you have these smart contracts that can themselves be the bearer of that asset. Once I put the digital asset into the smart contract, the smart contract decides based on its programming how to handle that asset based on other events that it's seeing in the world, and no human can take that money out of that contract ever again. And it's whatever code that was in there will self-execute when it needs to. And so that leads to all sorts of new products that could have never existed before, versus when you have a tokenized real asset, you have these additional issues of, first of all, you're trusting somebody else. And then second of all, if this is a bearer token, what if I lose the token? What happens to the gold that's backing it? And nobody can ever own that gold before. Like people talk, I think in some of these things it's solvable, but then when you solve them, you lose that sovereignty over the token, because the point of tokenizing something is to get that transactional benefit of like transacting on a blockchain and getting all that peer-to-peer transactional capabilities. And the fact that nobody can take that token away from you as long as you hold the private keys. But now, like I said, if I lose that token, what happens to that gold? Nobody can ever hold that gold again. Does the custodian just kind of keep that as a little bonus at the end of the year? Or does the custodian have a mechanism to kind of reclaim and issue a new token against that gold? And if they do have that mechanism, what does that tell you? That you don't really own that token because somebody else can override your ownership rights on that token. So there's a lot of things to kind of figure out still. Like I'm not saying that tokenization of real asset doesn't work, but it's super early right now, and a lot of these things need to be figured out. Versus in the pure digital asset space, it's already there. I mean, of course, there's more progress that needs to happen in terms of scalability and stuff like that, and people are working on layer 2 solutions because the transaction throughput when you conduct transactions in this sort of completely decentralized blockchain way is a lot lower than if you did it in a centralized way. But people are working on kind of improving that. But that's really the only sort of barrier in the pure digital asset space versus in the tokenizing securities or commodities or real estate or what have you. Those still have a lot of issues that need to be worked out.
I mean, Chad, did you have a comment to what Raghav was just saying in terms of, the challenge around, well, if you've got the key to it, you lose it, can you reissue it, the control that the custodian might have? Any thoughts on that?
Yeah, I mean, that's why I think there's different types of wallets. And I think the technology will become a little bit less confounding for new participants over time. The analogy I often use is, you have your iPhone. Does anyone really know how this works? I mean, yeah, you hit the button, you turn it on. But there's infinite levels of depth that you could know about an iPhone in terms of how does the electrons just move all the way through to your screen? Of course, most people don't know that. And so the point should be, you don't need to really be able to have to get into the complexities of how cryptography works and how keys work in order for this to have mainstream adoption. And I think that's why you're seeing, for instance, large firms now come into the space, like an example being PayPal, Revolut, Square, and there's going to be a lot more, because there's ways in which you can create a wallet interface where it's a custodial relationship, and then there's, I'd say, more sophisticated participants where they could have a non-custodial wallet where you're not relying on someone to actually hold the underlying assets. And so this can really be tailored to the sophistication of the institution, the individuals. And so to some extent, the technology right now is a little confounding. No one talks about MongoDB, these databases, or whatever it might be, Linux. Who spends a lot of time talking about that in a conversation about utility for an actual product that is facing a consumer? Not very often. But yet in blockchain, we spend a lot of time talking about it. And I think that's because it's just such early days. The technology hasn't been made quite as user-friendly as it could. That's partly what we're trying to change as Paxos, is make this really simple for someone to be able to come and get it. Ideally, a consumer institution shouldn't even know it's on the blockchain. And the reason is you're just sitting here from your wallet, you're hitting send, you're hitting receive. And it's going through rails that are blockchain, but it's not you actually having to figure out how to use the underlying technology, kind of like a DOS prompt on your computer. No one does that anymore. Oh, C, reboot, whatever, right? That doesn't happen. You just click a button that everyone can intuitively understand. We need to get to that point. I actually think we're pretty close to it. But you'll know we're close when we're out of the early adopter stage and we're into mainstream. And I think that's where the river hits the ocean. We're about at that phase shift, if you ask me, based on the pipeline that we're seeing just at Paxos. So I feel really comfortable in saying that while a lot of what's going on is not user-friendly, on the other hand, that was the same way for all new technology adoptions that come into place.
I mean, talking about the technology, I've actually got a specific question for you, Chad. I'll just read it out. At one point, Paxos had visions of digitizing and moving precious metals clearing onto a blockchain. Is that still a vision for Paxos?
Absolutely. And we're working with participants today to do that. Right now in the precious metals market, we have confirmed over $3 trillion of trades, millions and millions and millions of trades that have gone through with participants that use our post-trade platform. And the idea is our post-trade platform is a really logical way to be able to automate a lot of manual processes, because having those automated can also then lead very logically to settlement. And being able to move settlement around and being able to change the lags that happen. For instance, today in the gold market, oftentimes there is no real delivery versus payment at the exact same moment, meaning the dollars move and the gold moves and there's no difference in time. So then there would be no counterparty risk. That doesn't exist today. What a world there would be where you could not have counterparty risk when you trade assets. That's actually, I think, part of the vision of what blockchain enables. You can simultaneously move the payment leg and the asset leg when they're both tokenized. And that's what we've been spending a lot of time doing. We have $1.2 billion of tokenized dollars. Those are deposits we have that have been tokenized onto the blockchain. And we have $75 million of gold. That's going to increase. And we have sophisticated institutions that are in pilot stages settling trades right now. I think we'll be in commercial size in relatively short order, and we'll have more to say about that. And we're going to continue to grow the participants that want to use that, because it is a significant issue. You hit credit lines regularly. You have overnight issues when dollars move versus the gold. It's a big problem for treasuries. And I think all of that can be addressed by having a tokenization mechanism for that settlement. But again, that takes time. It doesn't happen overnight. You have to put the right controls in place, which is what we've done, building a lot of regulatory infrastructure. Having a trust company in the state of New York, we were the first one to have a trust. We're the first one to have access to the Federal Reserve National Settlement System, the first one to have full access to SWIFT when acting as a blockchain and crypto infrastructure provider. We've done a lot of these first for regulation so that people can rely on us. And I think it's very clear to me that those institutional markets are going to shift as well. It just makes sense.
Great, thank you. So I'm just going through some of the questions now. So for Raghav, again, I'll read the question out. So I trust maths, but less so technology. You still see the occasional hack, KuCoin, where gold coins were stolen. How do you get the average investor comfortable with that?
So yeah, and I think so. Loss of tokens is one of the risks when you're dealing with these digital bearer assets, and that comes with the territory. You cannot have a digital bearer asset that cannot be lost. Like if could you invent cash that you could never leave accidentally on a table and walk away and somebody takes it away? You cannot. And if you created a recoverable token, and that's what I was alluding to earlier with the, with the gold token, and sure, you can like do multi-sig wallets and whatnot to kind of prevent loss, but at the end of the day, loss can happen. But that is not the technology breaking or the mathematics breaking. The technology and mathematics are working exactly the way they're supposed to, which is that whoever has the keys should be able to spend the coins, whatever coin it is, right? Whatever token it might be. Now, these hacks that you're mentioning, nobody hacked into the blockchain and broke the way it's supposed to work, or hacked the token in some way. What they did was somebody was not securing the keys very well, and somebody took those keys away. So it's again, like that cash example I just gave, it's akin to, I'm running a bank and I just left all my cash on the out front porch and somebody came and took it away, and I'm like, oh, cash is terrible in terms of security because people can just take it away. And so the way you mitigate this is basically better cybersecurity, right? And that's something that we've built at Fidelity. We've built a very secure custody solution with hardware security modules and multiple keys and whatnot to prevent hacks like that from occurring. And it's basically your cybersecurity infrastructure that needs to be better. And then just as security improves and usability improves, we will enable. Right now, it's still a little nerve-wracking for the average consumer when they're like holding their own coins, because it's like, oh, if I do something wrong, I'll lose all my coins, which is fair enough. But again, as Chad was talking about the technology getting better, technology will get better. It'll get more usable. You have these hardware devices. You have, Samsung even put the secure enclave in their mobile phones in order to hold your crypto keys more securely and stuff like that. So I guess my answer really is patience. Like technology will get better. It'll get easier. In the meantime, you can learn the way you can mitigate the issue. In the meantime is to, just educate yourself and practice doing it so that you don't make mistakes. And in the future, other companies will help make it easier for you.
Great. So there seems to be a bit of a recurring theme. It's time. Give it time. And I think that's a point that you're both sort of making.
We're so early in this. We're so early in this. Sorry,
Chad, did you want to say something?
No, I mean, I just to reiterate, we're very early. It's.
Let me just pause you there, because there is a question for you that's just come through. So given the reliance of digital assets on technology, to what extent do you expect financial regulators to scrutinize and regulate technology?
Well, I think that they're probably not going to regulate technology. I think what they'll always regulate is the uses of technology. And so to date, you look across the technology landscape, I really think of technology as a tool. And you could regulate the tool, but you generally regulate the uses of the tool. Different societies have different rules on that, but that's certainly the way it seemed to have gone largely in the United States and in Europe. And I suspect that'll be more or less the framework that everyone's using. So if you look right now, no one's saying, let's regulate blockchain. And frankly, I don't know how you would actually do that. A lot of these are open source projects that are sitting out on the web. Anyone can access them. And I think the type of control that would be needed in order to actually regulate the underlying technology is something that I don't think most people would be comfortable with. So then it just comes down to, okay, we're not going to regulate the technology. That means you're going to have a different relationship with how people can use this technology than the way they use the financial system today. And so today, the financial system is basically a lot of private networks. Visa or MasterCard, even the Federal Reserve, DTC or Euroclear, these are all private networks, and you got to be a member of them in order to access them. But in an open system, you don't need to be a member. Anyone can access the network. But what you do is you have what are now emerging as a term, which is a VASP, a virtual asset service provider, and those will be regulated. And so you can have the entryways into the blockchain be regulated when it's not an individual person. And I think that will actually provide the right types of controls where you can have the privacy of doing it yourself and the access of doing it yourself. Remember, there's, even in the United States, 25% of the population is unbanked or underbanked. Crazy number, 50 million people. The reason that is true is because they're private networks and they cost a lot to maintain. And so having someone with only a couple $100s in their account isn't feasible. On the blockchain, it is. You can have $100 of gold, you can have $100 of dollars, and you now have full access to the financial system that's in the blockchain world. That's what's going to happen. And that should, in many cases, be unregulated. Where you want it to be regulated is when there's large amounts moving through. You don't want bad actors to suddenly have access to financial services that they didn't before.
Great. I mean, there's another interesting question that's come through for you, Chad, actually. There's a lot of gold tokens out there. Somebody wants to know, how do you view Tether, the largest market cap in gold?
Well, it's ostensibly the largest market cap of gold. It's not regulated. It doesn't have a primary regulator. It's not really audited. It's not following a lot of the standards that we set out and the LBMA has set out and the World Gold Council has set out for how you would do these things. And so I think it's unclear how much gold is actually backing it, which is not a surprise because that's also true for the dollar token they have. They ostensibly have potentially $1 billion hold. Now they may have filled that, may have not, in their dollar-backed token. And so it's really hard to get a clean read. If you look at the blockchain, their token isn't moving around. It's mainly held on their exchange, Bitfinex, which they own. And so that may be because that's their main distribution outlet, but it could be that it's really hard to figure out where the gold is. And maybe it's not fully backed. And so that's why we try to take a slightly different tact, which is we have a primary regulator, they oversee us. We have a primary regulator that oversees our token. We have auditors that look into the tokens and compare it to the gold that's sitting in the vaults. We have the tokens mapped to the serial number of the bars sitting in the vault. Then we have all these regulators who come in and do exams and outside independent auditors that examine the company, SOX, all this oversight so that people can have comfort to use us as a custodian. And that is, I think, how we are actually fundamentally different from actually every other token that exists out there. Nobody else is a regulated gold token that has a primary regulator that's overseeing it the way we do. And by the way, that's true of our dollar tokens too. So this is actually a process that we have tried to roll out across many different types of assets, because ultimately, I keep going back to, we want this to be mainstream. We want there to be mainstream adoption. You're not going to have mainstream adoption when you can't have trust. And certainly in the early adopter stage, it's a little bit of the Wild West. Kind of everything goes. It's you have a horse and a gun and you're going out into the wild. But I don't think that's the way you're going to build scale and build real utility to create a mainstream use case.
Great. I mean, one last question for Raghav, and then I think we should wrap up. We're already 10 minutes over. Raghav, so as I said, there's a lot of gold tokens or token projects out there, and you've obviously heard Chad just speak. Do you think there's enough room for a lot of them to coexist?
So I think this is, what I mentioned, there's lots of issues when you start tokenizing real assets, and this is one of them, right? Like, whose gold token should I use? Whose dollar token should I use? They're not fungible with each other. Like, in the perfect world, I should be able to take, one company's gold token and then redeem it for real gold at another company's gold token, because those tokens should be fungible, but they're not right now. In fact, right now, even whether it's dollar stable coins or whether these gold tokens, there should actually be a spread, and a lot of time there is a spread in the value between them, because as Chad just outlined, one company has one type of security practices and one type of regulatory regime that they're following, and the ways they vault the gold, the way they allow you to access it, et cetera, et cetera, et cetera. And that should actually lead to people in the perfect world to value one gold token more because of certain properties that it has versus another gold token. But that's not great with the idea of digital gold, because then you have 30 digital golds or 100 digital golds, and that creates this whole mess versus just having one standardized digital gold. And I think until we get there, we'll have all these issues, and it's not going to be a perfect world, and you're going to be having to listen to multiple companies pitching to you why their gold token is better than the other company's gold token, and then you have to make the decision. And to me, that's why I like the digitally native assets, because you don't have to get into these sort of arguments or fights or figuring out what's what. Everything is clear. A Bitcoin is a Bitcoin. It's a Bitcoin. There's no my Bitcoin and your Bitcoin. It's just Bitcoin. Just like the US dollar is cash, it's fungible. I don't care which bank it came from. It's just the dollar. And until we get to a world in which tokenized hard assets behave the same way, I don't think they really get traction.
Okay.
And
so
maybe
then,
could I actually hop in there too? I think there's a lot of gold tokens out there, and that's a good thing. And the reason that's a good thing is you want there to be competition in the market, and there's nothing like competition to really determine what is the right type of product that consumers in the market want to use. And so you wouldn't want there to be one right now because it's the early adopter stage. But I think that inevitably it's going to narrow down, because you have a Cambrian explosion, and then you have a winnowing out of the field. And I think that's what's happening. By the way, you have that exact same thing happening in crypto markets. There are thousands of tokens that have been created, but there's only a couple now that have really emerged as some of the leaders, including Bitcoin. But you have a constant period of growth and testing and discovery, and then a clearing out of those that just aren't providing the right level of utility. And I think that's going to happen in the gold market as well. And I think that's important because, how else is that going to happen? You want it to be transparent and market driven, and that's what this can allow.
Yeah, I think the difference between the multiple digital assets out there, I think the analogy there is more that there's multiple precious metals out there, not that there's multiple gold tokens out there. So all these digital assets are different digital assets. There's no two sort of projects sort of building the same assets. Like it's Bitcoin, Ethereum, Monero, they're all completely different, akin to gold, silver, palladium, platinum, whatever. But when you're trying to tokenize a real thing, and I agree with Chad that it's super early right now, so everybody's trying things, and competition is good. But my point is that at some point in the future, all these different providers need to figure out a way, and there are ways. It's just that's when the human coordination and actual legal contracts between companies come into play, which makes the whole process harder and messier. But at some point in the future, there should be sort of a fungible, a singular gold token, whereas as far as me as a consumer is concerned, I should not have to worry about which company issued this gold token. It should be just, this is gold token, and there might be 30 companies providing vaulting sort of services for that gold, and then I should be able to redeem it anywhere. And I think until we get to that point, it'll still be kind of messy with the way things are right now.
Yeah, I mean, look, I think that's a great place for us to end up, by the way. I'm cognizant though, there's lots of different gold ETFs and there's lots of different gold futures, but usually the liquidity, accumulates in the largest one, but there'll always end up being more than one, I think. And, but I think we feel great about the position that we're in as an industry. And, I think, that's just a natural process of the winnowing out.
So then just to wrap up, so just one comment from you both. What needs to happen? I mean, Raghav, you said we need to get there. Obviously, Charles, you've already mentioned a few times in terms of it's too early, but we're doing well, and it is about sort of compounding growth. What is the one thing that you think still needs to happen to really accelerate to the extent that it really hasn't, to get us there, to get that sort of a market cap that you are sort of looking to achieve? So let's start with Raghav first, perhaps.
I mean, I think a lot of things need to happen. Again, this whole blockchain space is on the whole super, super early. And, I mentioned scalability is one thing. Like right now, if you're trying to transact on a blockchain, you get Bitcoin can support about 3 transactions per second, and Ethereum can support about, Ethereum is the blockchain which most of these tokenization projects are tokenizing their things on, can do about 15 transactions per second. And when you're talking about the trading markets, you're talking about tens of thousands of transactions per second. So just on that, we have ways to go. And then, there's new blockchains coming up. So the question is, which blockchain should I tokenize my asset on, which is, may change in the future as well. So I think that needs to be figured out. There are layer 2 solutions people are working on that increase that scalability, but it'll come sometime in the future. There's regulatory stuff that needs to be figured out. So these are all bearer assets. There are, I talked about issues where people may lose their keys and they have no recourse. So there's a lot of things over there that need to be figured out. And then, like we were just talking with, when you're tokenizing hard assets, there's some sort of industry-wide reconciliation that needs to happen, which doesn't mean that only one company exists, like many companies exist, but they should all interface seamlessly in a way that the end user doesn't really know or care, where the real asset is being vaulted. So I think there's a couple of them, but there's a lot of things that need to be figured out. Usability, we talked about, that's another one. It's hard for end users right now to manage their own wallets. And yeah, you have companies that help you manage it for you, but then you're losing some of that control and sovereignty over your coins. And there's multiple ways to do it. So there's lots of things that being figured out. These are a couple of them. And I think it's still going to be quite a while before we're at the state of maturity as far as these markets go.
Sorry, Raghav, I sort of lost you because I got disconnected. So talking about technology, and I'm having problems myself. So I didn't actually get to listen to your response. However, this is recorded, so I'll listen to it after. I don't know, Chad, did you comment or?
I didn't comment, but I will, yes. I mean, look, I think the number one thing that needs to happen is time. And I don't think it's a lot of time. I think it's not too much time. When I look at the pipeline of customers for Paxos, and you potentially have the ability to bring billions of end consumers through our partnerships into the crypto ecosystem and the blockchain ecosystem, that tells me that it's time. I don't think any of the problems that we're facing are confounding problems. I actually think that they're relatively straightforward. They can be developed and worked through. They're engineering problems. They're not actual limitations, like time and space. And I think ultimately time, and not a lot of it, is what will create the adoption curve that will show that nonlinear growth. And so you're compounding very, very quickly right now, but off of small numbers. You continue to compound that quickly off of numbers that start to not be too small. And what looks like something that is far away becomes inevitable faster than anyone thinks. Kind of like how Amazon overtaking Walmart happened almost faster than anyone could have imagined, but for a long time, no one took it very seriously. So I think that you could be having this conversation in 18 months, and I think it could look a lot more obvious and potentially dramatically more obvious that this is where the industry is going, and everyone has to have the solution to it in order to be able to stay relevant. And I think the idea that this is some kind of just passing novelty, it couldn't be further from the truth.
Okay, well, we're 20 minutes over, but I think it was an extremely important discussion and actually a really helpful discussion. So I hope everybody enjoyed listening. Thank you so much to you both. Like I said, appreciate the early rise in the US, but thank you for sharing your thoughts with us. Sophie, over to you.
Thanks, Sakhila. That was a really interesting discussion. If anyone has questions, we've had so many coming through, and your questions weren't answered, please do email us at ask@lbma.org.uk. We hope that you will also be joining us in our next in the series. On the 12th, we're looking at the US election, gold and economic recovery shape with Ross Norman, Suki Cooper and Jim Steele. On the 19th, we have speakers from the Silver Institute and Metals Focus, looking at the new uses of silver. And on the 26th, we'll be talking about the evolution of the central bank gold operations, and we'll be joined by Isabel Strauss-Kahn and Simon Weeks. So it just remains for me to wish you a lovely rest of the day and evening, and to thank our panelists once again, Charles, Raghav and Sakhila. All the best, and bye for now.